Again, right. Well, credit tip of the day while we wait for this. Credit tip of the day. Don't get off this video because the video just started. Let's go.
Gains yesterday. Nice little take a look at the futures if we can. We had a big day of gains yesterday. Nice little, maybe a little bit of a Santa rebound, but well, it's gone out the window this morning in the pre-market. The Dow, the S&P, and the Nasdaq. Nasdaq down again 1%. Let's bring in Luke Lloyd to join us now to talk about it all. It is the final trading day of the year, Luke, and as we start a new year, as we look to 2023, what are the biggest risks in your mind?
Yeah, so there's a difference between the biggest risk in 2023 and the most likely risks. I mean, the most likely risk in our eyes is a somewhat mild recession that's a little deeper than what the average consensus is right now. I mean, with 5% to 6% unemployment and consumers finally cutting back their spending habits, which impact earnings estimates and valuations in 2023, both of which, in our opinion, is still too high. I mean, the biggest risk of them all, which isn't likely to occur, but something we do have to pay attention to, is a credit crisis. I mean, if unemployment spikes to the high single digits, there will be consumers that default on their debt. That could snowball into companies that over-leverage themselves to default on their debt too. So a lot of companies did over-leverage themselves the past decade because of low-cost capital, and some companies have never operated before in a recession. So here's a quick stat, Ashley. I mean, the Nasdaq has almost 3 times the debt to equity compared to the S&P 500. Many high-growth tech companies are going to have a hard time in 2023.
Well, that's interesting you should bring that up. I think of all the 11 sectors in the S&P this year, only 2 are on the plus side, energy and utilities barely. In this kind of doom and gloom environment that we hear so often from analysts, what, as an investor, should you do? Do you run and hide, put your cash under the pillow?
I think you have to be patient until about middle of next year. I mean, there's going to be some pain next year. There's no getting around that. I mean, heck, the Federal Reserve is intentionally inflicting pain to cool demand on inflation. But I don't think a credit crisis, is likely to happen or any kind of horrific thing because the Federal Reserve and the federal government seem to always be there to backstop everything in today's world. If defaults started rising and unemployment goes higher than what's needed to combat inflation, all the Federal Reserve would do is lower rates, and all the government would do is play the same playbook they've been playing and print trillions of dollars to stimulate the economy. The government and Fed saving the day might seem like a good thing at the surface level, but long term, we need markets and the economy to stimulate themselves through the free market and innovation. But I just think right now you got to be patient. I mean, not a lot of things look attractive. You got to wait for stocks to fall into your lap. You can't go out there and chase stocks right now. Sell-off hasn't truly happened in our opinion.
Wow. Yeah, this is take this video as a wake-up call. Like, if you're in debt a lot, start paying off that debt, because in case because it's already started, the massive layoffs. The banking industry, the tech industry have been in layoffs. So you definitely want to start scaling down when it comes to your debt. So again, remember, DTI plays a big factor when it comes to your loan. So if you're definitely over leveraged, start paying it down so that you can have more, so you can go ahead and continue decreasing that debt to income, and then also not running into any credit problems like missing your payments, which again count for the highest part of your credit score. So yeah, this is take that video you just saw as a wake up call to start getting yourself out of debt. So yeah. So last